The world is changing. Investors need to pay attention to what's going on outside of North America because the markets are speaking. Investors over the last number of years have been able to just focus on the North American markets, but there's a lot of important signals that are taking place outside of the North American markets. So let's take a look at what's happening in the bond markets because that's important for the stock markets as well. In my July newsletter, I start with this picture of the globe with an eye in it because you need to pay attention to what's going on. Everything is changing and we need to keep our eye on the world ball. So let's take a look at the bond markets. A number of weeks ago, I shot a short video on the yen carry trade and how that could cause problems. If you take a look here, I did put a link here if you want to watch that on my channel. I would appreciate it if you do watch it, if you subscribe and like the videos as well. And I go through the process of describing what a yen carry trade is and how it works and talk about could it happen again. The yen carry trade is basically when institutions and hedge funds borrow in Japanese yen at very low rates and flip the currency to USD, buy government bonds in the United States or the NASDAQ on leverage. And it works extremely well as long as everything works out fine. And the problems start when you see the Japanese yen move up, so the cost of carry becomes more expensive. When yields in Japan move up because the cost of carry becomes more expensive, or the US markets start to have some trouble here. And so we've seen a combination of this happening, and we saw in 2024, we did see the yen carry trade unwind a bit and cause some problems in the market. And we could see this once again bubble up. If we take a look here, this is the Japanese 40-year yield. It got close to zero before COVID, and look at what's happening here. It's been going up. The Bank of Japan has to let it rise because inflation is becoming a little bit of a problem, which means that with higher yields, the Bank of Japan is now starting to suffer a little bit here, and it's becoming more expensive for governments to finance their debt. Now, I point out Japan here and say that the yen carry trade could be problematic if it starts to unwind, and there's still a lot of investors doing this trade, so we did see it have an impact on the markets in 2024, and that could come back once again. But Japan's not alone. It's not just Japan, it's also the UK, Germany, France, and other countries as well. Here's the UK 30-year gilts here. You can see this is when Liz Truss was in power briefly. She proposed a supply-side economics policy. The elites didn't like it. The Bank of England, for political reasons, didn't support it. And we had some problems with the IDL for the insurers where they had used leverage for fixed income. It was kind of a crazy time. So next thing you know, Liz Truss is out. We had a new government come in after that. And then we had a new government after that, the Labour government with Keir Starmer, and which has been an absolute disaster. The economy is really in trouble here, and we're seeing the yields move higher. So also in Germany here as well. Here's Germany. Look at the yields move up here and climb once again here. So we've seen some really climbing yields. Now, I do want to say with a caveat. So Germany constitutionally, up until very recently, had a cap of 60% government debt to GDP because they're scared of the hyperinflation that they had under the Weimar Republic. Recently and foolishly, they extended this. They said, we have more headroom to spend more money. Sounds like a lot of other governments around the world. And so they've ramped up their spending even more. But still, relative to other countries, they're kind of solid. The reason yields are moving up here, yes, it has a lot to do with governments, the German government spending more money, investors not liking it. But it's also the EU. The EU is really problematic. The EU is... they're introducing more regulations and they're playing around with the bond market. So when the EU issues bonds, it hurts Germany, and we see yields climb here. And we've artificially seen German rates move too high, and Italian rates, Portuguese rates, etc. These countries, their yields have been too low because of their policies. But so we've seen yields rising in Germany. So not just the UK, but also Germany. I can show you other graphs with France and other countries. We're seeing the same thing. So what's happening? Why are yields moving up in countries around the world right now? Well, if we go back to 1981, rates were extremely high. We saw interest rates structurally come down year after year. And bond investors gave governments some leeway, and governments came out and said, oh, we're going to invest into the economy. We're going to increase our investment. spending. Okay, so they want to increase their spending. And bond investors said, okay, you know what, that's okay. And the cost of the financing that increasing debt kept going down in the sense that interest rates were going down. Now, the total amount was accumulating. But so bond investors kept giving them some leeway here. But what we've seen over the last few years is interest rates have bottomed and perhaps heading higher, is bond investors are now looking at things differently. We're seeing bond vigilantism. So right now we see the U.S. here, they are projected to have a deficit of $8 trillion over the next 4 years. That's absolutely insane. And Canada is expected to have a deficit of $225 billion. Absolutely insane, huge amounts of spending. I mean, the governments in both these countries are saying, oh, we're cutting back in these areas, we're cutting spending. But the reality is the spending is increasing dramatically. And what we're seeing is bond vigilantism. And bond investors are just saying, look, you know, we've seen this before. The debt increases. And you may say, well, you got great plans, but it just doesn't seem to work out that way. So that's what's happening to yields around the world at this point. It's not because the growth is good. Bond investors are starting to demand higher yields for increasing deficits and debts. And we haven't seen that really in quite some time. Okay, what about stock markets? I mean, that's what everybody's focusing on. Everybody wants to know about the stock markets. Very few people pay attention to the bond markets. So here's Europe. And let's take a look and see what's happened to Europe versus the US. First of all, here's 2025. We can see that Europe has done extremely well relative to the, on an absolute basis, and also relative to the US, at least in the first few months of the year. Then we have seen this pullback where the European market has headed lower relative to the US market. But to put things in perspective, over the last 3 years, the European market has underperformed the US market. So what happened here? Why did the European market outperform the S&P 500 in the first few months of the year? Is it because the European economy was so strong? No, absolutely not. This was because investors around the world, institutions, were basically saying, well, tariffs are coming in, we're not so sure. We put so much money into the US, tariffs come into play, the demand for US dollar will go down because there won't be as much imports coming back into the US, and let's just be safe. And so they sold a lot of the assets in the US. We saw currencies being sold, etc. And they went back to their home currencies and the stock markets. And so we can see the outperformance of the European stock market. So it didn't have anything to do with strong economies. It had to do with a reallocation because of what was happening politically and geopolitically. So can that trend continue? Can we see Europe perform? Absolutely. There will be times, I think, over the next few years where Europe will outperform the U.S. market. I think there's a bit of a wake-up call for us to see the European markets outperform for a bit. I don't think this is a structural change where all of a sudden now Europe's going to outperform the American market for 10 years or so. I think there will be sectors of the economy that can do extremely well in the U.S. But it is a wake-up call for investors to say, hey, maybe we should be looking at European markets occasionally, especially in strong seasonal periods or emerging markets or other markets as well. But I think that's really the message here with the strong outperformance at the beginning of the year. Okay, here's the UK, absolute basis, performing well since in 2025. Same pattern as Europe, really. Outperformance at the beginning of the year for the same reasons, and then underperformance since really the April bottom. I had to laugh here. Here we have Jamie Dimon. He's always saying something a little bit crazy. Here he says that his message to Europe was, you're losing. And really, it's a message to say, look, first of all, investors should understand that the EU is an unelected institution, okay, that oversees the governments. And it's increasing the number of regulations and taxes on companies in Europe. It's kind of crazy. And so what you see is you keep seeing more and more obstacles for European companies and to do well. And that's really what Jamie Dimon was talking about when he was giving this interview. He's basically said, this has to stop. But Europe keeps down this path, and he said you're losing because of it. Here's the Japanese stock market. You can see that it's done very well, but here's a breakout that took place here back a little ways in earlier this year, and you've seen the Japanese stock market do well. But look, the same pattern as what's happened in Europe and the UK as well. So basically money going back to Japan, causing the same type of allocations. Okay, I want to take a look at the US dollar because it's really suffered in 2025. I want to try and take a look at what's happening here. I actually I built this graph here. So this is from 1972 to 2025. This is the US dollar relative to world currencies. All these gray lines represent different years here. But the red line here is the 1973. The blue line is 2025. So you can see here that the blue line here for 2025, in the first half of the year, the US dollar suffered the biggest drop, 10.6%, since 1973. Okay, it should be noted, by the way, that in the second half, the US dollar did extremely well relative to world currencies in 1973. Perhaps that's what takes place here with the US dollar so oversold. There was a lot of a knee-jerk reaction that took place back in that January, February, March timeframe. But we're starting to see that settle down. So I would not be surprised to see the US dollar actually bounce here from this very oversold level. Okay, here's a graph of US dollar relative to the world. That's the red line here. And this is USD relative to euro. That's the black line. So they generally overlap going all the way across here. But look what's happened here. We've seen that big, huge gap develop. So what is that telling you? So the euro, it makes up most of the basket relative to world currencies. There's different ways of measuring it, but in most baskets, it is the largest component. And so what this is saying, it's the euro that's doing well relative to the US dollar, not so much the other currencies around the world, like emerging markets currencies, etc. And once again, that's being caused by the investors selling U.S. assets, flipping the U.S. dollar into the euro, and buying their own market as well, so demanding higher for the euro. Will this continue? It could continue. A lot of people are talking about de-dollarization, etc. And sure, I think that is taking place. But I don't think we're going to see the U.S. dollar continue to slide down that we've seen happen so far. We're starting to see some stability take place in the market for the U.S. dollar relative to world currencies. And if you take a look at the interest rate differential as well. So watch out. Yes, things have changed, but we could see the U.S. dollar do well in the second half of the year. And I do want to say on a seasonal basis that the U.S. dollar tends to perform well relative to world currencies in most of the second half of the year up until December. Now, the reason why December doesn't work so much for the U.S. dollar is we tend to see a large amount of remittances leaving the U.S., going back to home countries coming into Christmas, New Year, and that tends to put downward pressure on the U.S. dollar. But October, November, as an example, tend to be very strong for the U.S. dollar. So we could see the U.S. dollar do well coming up. And I think that knee-jerk reaction that took place earlier in the year, I don't think we're likely to see that same strength when the European economy is relatively weak compared to the U.S. economy. Tariff fatigue. Yes, there's tariff fatigue out there. If you take a look at what's happening here. Do you remember back when, we had the first tariffs announced as the end of the world, and then there were extensions and delays and misinterpretations, and I don't know, it's been kind of a crazy ride actually. And, counter tariffs, et cetera, et cetera. And investors basically they've just had fatigue. And so they keep assuming that everything's going to work out fine, everything's going to be delayed. And so far, they have been right. We've seen more and more delays or extensions. And even last week, we saw another extension. But at the end of the week, we did see Trump come out and announce a 50% tariff on copper. Now, I got to say, I understand some of the tariffs, to protect strategic interests, et cetera, et cetera. Canada's got high tariffs on different countries for different reasons. The U.S. Does as well. But this one doesn't make a lot of sense. And the reason being is that copper is basically an input for other products. Now, Trump talks about copper being needed for EVs and et cetera. And he's absolutely right. And so if you take a look, there are a number of countries around the world that actually produce copper. It's not like rare earth metals where China dominates. So the liability issue isn't quite as big. So the U.S. actually produces around 55% of its own domestic production. And Trump wants to raise that up. But the problem is, in the short term, what you're going to see, and even longer term, is higher prices for things like homes, because there's a lot of copper wire in homes, or EV cars as well, because there's a lot of copper wire. Typically, what you want to do is you want to put a tariff on a finished good coming into a country, because you want your own country to add the value to the products internally. But copper coming in now increases all these other costs for products. So I don't expect this one to last with the 50%. I think maybe there's going to be graduated scale over a number of years. Maybe it's 10% the first year, etc. I get, well, maybe he wants to help the copper miners out, but to say 50% on this day, that doesn't make sense. So anyhow, we're seeing some tariff fatigue. The danger with the tariff fatigue, by the way, is that all of a sudden one day, Trump does actually say, that's it. We're actually, having some tariffs, more tariffs in place. And there are more tariffs in place right now, and tariff revenue in the States is going up. But all these delays taking place, we may actually see Trump come up and start really doing some hard lines and letting the tariffs actually flow in an even bigger way as well. That's the danger. And that could hurt the stock market in the shorter term. Okay, I want to talk about the seasonal trends of the stock market at this time of the year. So May and June tend to be so-so months, not great months for the year. And we've seen the stock market do extremely well. July and the first half of the month tends to be strong. So towards the end of June, coming into July, we tend to see a strong market. It's the next 2 months, August and September, that are concerning. If we take a look here, this is the S&P 500 average monthly gain from 1990 to 2024. Here is August and September, the two worst contiguous months of the year. And so this is the concerning part. Sometimes I call this the dead zone. If the market is going to go down, this is often where it goes down. So yes, the stock market can move higher. Now, it tends to perform well in this time period when there's strong action from the central bank or the government, some huge catalyst to drive the market higher. But barring that, we could see some weakness coming up. Now, I do want to have a caveat on a positive note. If we do see some weakness that takes place in August and September, if it's major weakness, very often what you find is right here at the end of September tends to be a good entry point to the market, or later in October as well. So yes, we could see some weakness, but that could lead to a good buying opportunity. Let's talk gold. Gold's been on fire. It has a strong seasonal period from July 12th until October 9th. Very often that does end in September, but we tend to see it do well at this time of the year. Gold's been performing extremely well in 2024 and 2025. Right now, if we take a look here, we've got a consolidation taking place. Yes, we have broken this upward trend line here, but we are consolidating. And it really, if we want to ballpark it, really it's around 3,000, 3,100 at the bottom here and 3,500 at the top. If we see a breakout above 3,500, we could see a lot of media attention for gold. And we do have that strong tailwind of a strong seasonal period. So why did gold move up here and now it's in the consolidation period? If you take a look here, first of all, the interest rates have moved lower in 2025, which helped to move the gold higher, but also the US dollar heading lower. One of the driving factors for gold is the US dollar. And when it moves down a lot, it tends to support a higher gold price. There are other factors such as central bank buying, but this has been a large factor helping gold to perform well at this time. So watch out for those breakout levels. So if we see above 3,500, that's really going to be, I think, a really hot spot. And if it goes really below 3,100, maybe we might see some further weakness a little bit, but 3,500 could really drive it higher. Not to be outdone, silver has been doing extremely well. Tends to perform well at this time of the year. It did have a breakout in June on an absolute basis. A lot of investors got excited about that. And silver, and this is silver relative to gold, it has been outperforming gold at this time. I did a video recently. It's on my YouTube channel. It's silver gold to silver ratio. If you go to @Thackray, you'll see it there. I don't have a link here in this case here, but I do talk about the ratio and what's taking place. And a lot of investors are getting excited about silver, which has been lagging gold. Okay, here's a graph here, a long-term graph for silver, and this graph, and it's got a cup I've drawn this picture, and a handle, which long-term investors for silver are going, wow, that's extremely bullish for silver. I'm not so sure so much, if the price is back a few decades ago, matter that much, but a lot of investors are paying attention to this at this point. Okay, correction. Actually, here's the gold-silver ratio, and here is a link that you can take a look, click on to get to that video. Biotech tends to perform well at this time of the year. We have seen a breakout on an absolute basis, and we've seen this consolidation taking place. Now, biotech over the last few years has been underperforming the S&P 500. Now, interestingly enough, it's actually done okay in its strong seasonal period here. But here we are in this consolidation phase as we've entered into the strong seasonal period for the biotech sector, which is a bullish setup. Canadian banks have been performing well in 2025. We did see them underperform in the first part of the year coming into April, and then they've been outperforming since. Investors have been favoring Canadian banks. I would actually be taking a look at the U.S. banks reporting earnings this week, actually. They could give some clues to the strength of the banking sector. I know the U.S. banking sector is very different than the Canadian banking sector, but it could give some clues to future performance for Canadian banks. Here's the Canadian dollar versus the U.S. dollar. And if you take a look in 2025, the Canadian dollar has been doing really, really well. Or has it? Or maybe it's U.S. dollar that's been going down relative to world currencies. And that's really what's taken place here. The U.S. dollar has been going down. And here we are back in this consolidation area here. And at this point here, it does have a little bit of room to move higher. I'm more concerned with the fall time of the Canadian dollar starting to head lower, depending on economic reports. But if the U.S. dollar does well relative to world currencies, we could see the Canadian dollar underperform. Here's the utility sector outperforming when the market was in trouble, underperforming when we saw risk on. We have seen a breakout here recently for the utility sector. We could see it do well if the stock market starts to tumble. Okay, government bonds. I know investors aren't necessarily interested in government bonds so much. Here's the 7 to 10 year U.S. government bonds. We are in the strong seasonal period. July tends to be a strong month for government bonds. U.S. government bonds. We have been in a consolidation period, and we have been positive. Bonds have been positive for the U.S. Yes, we saw that spike down when everything took place earlier in the year, but it's been a little bit of a stealth market for U.S. government bonds. So right now, we are in the stronger part of the year for government bonds. So we could see government bonds actually perform well, particularly if we see the market start to struggle. And here's a graph of seasonality. This is monthly performance. Here's July here. You can see that overall, a lot of green tends to take place for U.S. government bonds over the last 20 years. Rant time. Okay, well, here we are. I say, did he know? This is Jeff Bezos. Here he is dressed up. I think this is for his wedding. This is one of his boats, interestingly enough. Actually, I like the old Jeff Bezos, the nerdy guy that used to sit at a computer working all the time for his company, driving this old car. He drove this old car forever. Maybe I'm just jealous. I don't know. But I like that guy here. But if you take a look, Jeff Bezos did sell nearly $1 billion worth of Amazon shares last week. Actually, he sold a bit more in the end. But over a couple of days, he did sell an awful lot. My rant is maybe he actually knew. If you take a look at what happened on Prime Day in the States, it was down 41% of sales on the first day compared to last year. We've seen the retail bricks and mortar getting pummeled for a while. Online's been holding out, but maybe online is starting to suffer. Okay, my next rant. Here it is. 2 chairs of the Federal Reserve, 2 popes. Okay, what am I talking about? So I did this video actually, and there's a movie called Two Popes. I just put the picture in there. And there's a scenario where we could see 2 Federal Reserve chairs next year. And you say, how's that even possible? One would be official, Powell, and the other would be unofficial. How would that play out? So just if you take a look here, Andrea Kugler, okay, she's on she's an FOMC member right now, is set to finish her term in January 2026. Trump could appoint a very dovish person to take over her place. So that person would be sitting on the board, knowing that that person would be waiting to be take the reins from Powell. Already announced. So Powell would be sitting on the meeting, making his statements. The media would be rushing out and talking to the other person who they know will be chair in a month or two. Now, that would be interesting. Now, we did have 2 popes back, I think, in the 15th century. That did not work out well. Okay, it was a time of turbulence. So maybe if we have 2 chairs of the Federal Reserve, that may not work out as well. My last rant here is, are JPEGs still overvalued? Now, remember the JPEGs that we're selling? Like NFTs, but they're just pixels, pictures, basically. Here's one that sold at $1.7 million 3 years ago. Now it's valued at $761, a drop of 99%. There's nothing really unique about these things. But the big question is was this just a method of money laundering? Yeah, maybe, because it was kind of crazy, wasn't it?